Most people today have learned not to worry about debt. We hear that government debt doesn't really matter, that the world just owes money to itself, and that as long as economies keep growing, the numbers on the screen are harmless. The story sounds reassuring. It also does not match what history shows. Global debt today is the largest financial experiment in recorded history. If you add up public debt, corporate borrowing, household loans, and financial leverage, the total now sits above $300 trillion. That is close to 4 times the value of everything the world produces in a year. We treat this as normal and permanent. Yet in every earlier civilization that pushed debt to extremes, it did not stay background noise. It became the fault line along which the system eventually cracked. In this video, we will not ask whether debt will ever cause a crisis. History has already answered that question many times. The real questions are when, how, and who ends up paying the bill. Debt is not just numbers on a ledger. It is a system of power. A lender does not simply hold a claim on money. They hold a claim on someone else's future work. Debt reaches forward in time and pulls tomorrow's income into today. That can fund useful things like bridges, schools, and businesses. It can also become a quiet chain that ties households to banks, governments to bond markets, and entire generations to promises they never voted for. The key point is that this system is not neutral. When things go wrong, large institutions are often protected. Borrowers, taxpayers, and wage earners are left to absorb the shock. The pattern is old. We can see its outline as far back as the first cities. Our case study begins around 3000 BCE in Mesopotamia. Archaeologists have found clay tablets that look like simple receipts. In reality, they were debt contracts. Farmers owed grain to temple storehouses. Herdsmen pledged livestock. Families pledged labor. Debt operated through the palace and the temple, which were the economic and religious centers of society. The crucial insight is that ancient rulers already understood how dangerous this could become. Bad harvests were common. When crops failed, peasants could not pay. Interest charges turned one bad year into a permanent burden. Families lost their land and their freedom. Without intervention, the economy would slide toward a world in which a small group of creditors owned nearly everything, and everyone else sank into bondage. To avoid that outcome, some kings used a tool that sounds shocking to us. They periodically wiped the slate clean. Through royal decrees known as debt jubilees, personal debts were canceled, land was returned to its original families, and debt peons were released. These acts were not seen as moral charity. They were a form of system maintenance. Too much personal debt threatened the tax base, the army, and social order itself. Forgiveness was a reset switch that kept the machine from tearing itself apart. The earliest civilizations, therefore, treated debt as powerful but dangerous. It could enable trade and specialization. It could also, if left unchecked, turn into a slow-motion collapse. Over the centuries, this practical wisdom faded. Religious traditions kept the language of jubilees and mercy, yet rulers in later eras grew more reluctant to acknowledge limits. By the late Middle Ages and the Renaissance, Europe had moved from agricultural IOUs to something more abstract and scalable. Banking families in Italian city-states developed book entry credit. Instead of moving sacks of grain or chests of coins, they moved promises. They lent to merchants, princes, and even popes. States discovered that they could wage longer wars and build grander projects by borrowing against the future tax payments of their subjects. Debt was no longer just a personal matter between farmer and landlord. It became the bloodstream of emerging nation-states. The new system increased capabilities but also magnified risk. It allowed rulers to spend far more than their current income. It tied the fate of governments to the moods of creditors in distant cities. When confidence broke, the crash could cross borders with the speed of a message on horseback. Spain in the 16th century shows how even apparent wealth cannot protect a state from this logic. After the conquest of the Americas, silver from the New World poured into Spanish treasuries. On the surface, Spain looked unbeatable. Yet the crown repeatedly borrowed against that silver to finance wars across Europe. When military costs outran inflows, Spain defaulted 4 times in that century alone. The lesson is simple. Having resources does not immunize a country against debt failure. If obligations grow faster than productive capacity, the math eventually stops working. By the 20th century, debt had become openly geopolitical. Governments issued bonds not only to build railways or ports, but to fight industrial wars. Credit markets decided which empires could afford to mobilize and which could not. Treaties written after wars often hardened debts into political weapons. The clearest example is the period after World War I. The Treaty of Versailles imposed heavy reparations on Germany. On paper, these payments were compensation for the damage of war. In practice, the numbers far exceeded what the German economy could realistically deliver. The country tried to pay by borrowing abroad and by printing money at home. When foreign lending dried up, the government turned increasingly to the printing press. Between 1921 and 1923, Germany slid into hyperinflation. Prices spiraled upward. Savings evaporated. Pensioners who had worked an entire lifetime found that their money no longer bought a loaf of bread. The collapse was not just a financial event. It was a breakdown of trust. People who had believed in contracts, salaries, and bank deposits now saw them as traps. This is the deeper mechanism. Excessive debt does not simply create big numbers on balance sheets. It erodes faith in the rules of the game. When that faith breaks, societies become vulnerable to extremism and bizarre solutions that would have seemed unthinkable a decade earlier. After the even larger destruction of World War II, leaders tried to build a more stable architecture. At Bretton Woods in 1944, they designed a system that would anchor global money to something seemingly solid. The United States held about 2/3 of the world's official gold reserves. Under the new rules, the dollar was pegged to gold at $35 per ounce. Other major currencies were pegged to the dollar. Debt contracts, foreign exchange reserves, and trade balances were effectively tied to the credibility of U.S. financial discipline. For a while, this compromise worked. It allowed reconstruction in Europe and Japan and gave investors a shared reference point. But it also created a hidden dependence. If the United States ran persistent deficits, the rest of the world would accumulate claims on U.S. gold. If those claims grew too large, confidence in the system would crack. By the 1960s, that is exactly what happened. The U.S. government increased spending at home and abroad. The Vietnam War and new social programs required more dollars. Foreign central banks held growing piles of those dollars and began to doubt that each one was truly backed by gold at the promised rate. Some demanded conversion. In 1971, President Nixon ended the convertibility of the dollar into gold for foreign governments. This Nixon shock did more than adjust a price. It marked the birth of a full fiat system in which major currencies were no longer tied to any physical constraint. From that point on, the limit to debt creation was not scarce metal. It was the amount of trust investors and citizens were willing to extend. The modern era of almost infinite debt had begun. Governments could borrow and create money to smooth recessions. Central banks gained enormous influence by setting interest rates and by acting as lenders of last resort. When growth slowed, they could push rates down to encourage borrowing. When crises hit, they could expand their balance sheets and buy assets directly. This approach treats debt as a stabilizer. When the economy dips, you push more future income into the present. The problem is that each rescue creates an expectation of the next one. Debts that might have been written off are instead rolled over. Leverage ratchets upward. The system requires ever larger interventions to keep functioning. By the 1980s, governments in advanced economies embraced this model. Public debt rose to fund defense buildups and economic restructuring. At the same time, many developing countries borrowed heavily in foreign currencies, especially dollars. When interest rates rose and global conditions shifted, some of these countries could no longer service their loans. Latin America entered a long debt crisis. Defaults and emergency programs followed. The pattern that emerged was clear: borrow to grow, then rely on international institutions to manage the fallout. Losses were spread across populations. Key financial actors survived. The global financial crisis of 2008 revealed how deeply this pattern had penetrated private finance. Housing mortgages in the United States were bundled into securities, sliced into tranches, insured with derivatives, and leveraged by banks at ratios as high as 30-1. Officially, risk was dispersed. In reality, it was concentrated in a system that could not handle falling house prices. When the bubble burst, banks failed, pensions lost value, and unemployment surged. Governments responded with massive bailouts and stimulus programs funded by new debt. Central banks slashed interest rates to near zero and, in some cases, below. They also began large-scale asset purchases. The message to markets was simple: the system would not be allowed to fully purge bad debts. It would be supported from above. In the years since 2008, global debt has not stabilized. It has accelerated. Roughly speaking, total world debt has tripled in about 2 decades and passed the $300 trillion mark by 2023. Japan's public debt now exceeds 200% of its annual output. The United States has crossed $34 trillion of federal debt, with annual deficits normalized rather than treated as emergencies. Interest payments on that debt are beginning to rival core government programs, including defense. In Europe, several countries carry persistent debt levels above 100% of GDP, while sharing a common currency that they do not fully control. This limits their ability to devalue or inflate their way out of trouble. In China, local governments and state-owned enterprises have built large off-balance sheet obligations. Official figures likely understate the true load. Growth has been sustained by ever more credit. For households and businesses, the psychological trap is simple. Debt feels abstract. Swiping a card or signing an online loan agreement is easier than watching taxes go up or spending go down. For politicians, borrowing is less painful than telling voters no. The burden shifts quietly into the future. That future is now being tested. Since 2022, many central banks have raised interest rates to fight inflation. The cost of servicing existing debt has climbed for homeowners, corporations, and governments at the same time. The entire structure is discovering what happens when the price of time itself goes up after an era of near-free money. High and rising debt does not distort only balance sheets. It also distorts behavior. Cheap credit encourages speculation and asset bubbles. It pushes money into real estate, stocks, and complex financial products, not always into productive innovation. Those who can borrow at low rates often see their wealth multiply through leverage. Those who rely on wages alone struggle to keep up with inflated asset prices. Historically, systems with extreme debt loads have faced only 3 broad endgames. The first is genuine repayment. This is rare when the numbers reach extreme levels, because it would require years of surplus and restraint that most societies do not sustain. The second is inflation. By allowing prices and wages to rise faster than interest rates, governments reduce the real value of outstanding debts. This is a kind of silent default. Creditors are paid back in money that buys less than expected. Savers and wage earners carry the cost. The third path is default or restructuring. Here, the loss is made explicit. Debts are written down. Contracts are renegotiated. Sometimes this happens through organized agreements, as in parts of the Eurozone during the Greek crisis. Sometimes it happens through abrupt sovereign defaults, as in Argentina or Russia at different moments. Each route involves social and political stress. The deeper truth is that every borrowed dollar or euro represents a claim on someone's future labor. When societies pile up claims faster than they build real productive capacity, they are writing promises that cannot all be kept. Over time, those promises shape power structures. Banks are rescued because their failure would threaten the system. Large corporations are restructured rather than erased. Political leaders rotate in and out of office while the obligations remain. The public, as taxpayers and workers, absorbs most of the adjustment through slower growth, higher prices, or reduced services. None of this means that all debt is bad or that collapse is imminent. Debt can fund useful investments. It becomes dangerous when it grows faster than the underlying ability to create real value, and when it is treated as a risk-free solution to every shock. From Mesopotamian tablets to Spanish bankruptcies, from Weimar paper money to modern bond markets, the pattern repeats. Debt is used to stretch present possibilities. For a time, it works. Then the bill arrives. The final insight of this hidden system is simple but uncomfortable. No empire and no global order has escaped a reckoning with its debts. Timelines differ, mechanisms differ. Some endgames are chaotic, others are managed, but the basic arithmetic does not disappear. Understanding this is a form of self-defense. It does not tell you which asset to buy or sell. It does remind you to look past comforting slogans and to ask how promises will actually be honored. Who is taking the risk? Who is protected? Who is being quietly handed the bill? In the end, money is built on trust. Debt is trust written into contracts and numbers. When that trust is stretched too far, systems become fragile, even while they still look solid on the surface. History suggests that awareness does not guarantee safety, yet it can help us move from being surprised by each crisis to recognizing it as part of a long pattern. If you found this perspective useful, consider sharing it with someone who still thinks debt is only a background number. The more people understand the system we all live in, the less likely we are to be caught entirely off guard when its weaknesses.